Hi, Professor Rex here. In this week's video, I'm going to focus on the two dividend stock portfolios in yellow in which we invest additional money on the first trading day of every week. They are the Dividend-Growth portfolio, which was started in 2022 and now has an annual return of 17.52%, and our high yield stock portfolio, which surprisingly has a higher return of 27.19%. The high yield portfolio was started in 2023. In next week's video, we'll talk in depth about our newest portfolio, the tech stock portfolio that my accounting students and I started last year as outlined in red, and now has an annualized return of 23.79%. It's our newest portfolio, and because it's 100% invested in risky tech stocks, it's our most volatile portfolio. Like our dividend stock portfolios, the tech stock portfolio is a real-world investment portfolio where I make additional investments on the first trading day of each week. So in effect, all three portfolios are accumulation portfolios mimicking someone in their working years who is consistently adding to their investment portfolios. As a reminder, the portfolios on the right in the light blue outline are portfolios that I started in 2003 when I was in college. These portfolios are more buy and hold portfolios with infrequent trading, so their lack of action might make for boring videos. So you can go online to beatthestockmarket.com to read more about them if you like less frequent trading. First, let's do a quick performance overview. Our best performing portfolio so far is, surprisingly, our high yield stock portfolio, which now has an annual return of 27.19%. I would have thought that the dividend growth portfolio would be beating it because it's really hard to have both a high return and high yields. And the high yield stock portfolio is handily beating the S&P 500 since the portfolio was started. And our dividend growth stock portfolio, the original portfolio that we started, now has an annual return of 17.52%. That's the portfolio that's shown on this graph. Now, both of our dividend stocks portfolios did well since our last video compared to the S&P 500, which saw many of its momentum stocks get hammered recently. And our high yield stock portfolio and dividend growth portfolio do not have many of these momentum stocks. However, the tech stock portfolio does have a lot of those. But more importantly, both of our dividend-centered portfolios are beating their true benchmark, which is the ETF with the ticker symbol SCHD, which we'll discuss later in the video. And our tech stock portfolio is our most volatile portfolio since it's 100% invested in tech stocks and is the portfolio we started most recently. Its annualized return is 23.79%. Because it's our newest portfolio, its performance since inception jumps around a lot more than our other portfolios. And later in the video, I'll discuss ways to potentially boost the return of our stock portfolios, but it will require giving up some portfolio diversification. But depending on how much diversification you require, that might be relatively easy to do, as our dividend growth stock portfolio currently has 105 holdings. Our high yield stock portfolio has 37 holdings, and our tech stock portfolio has 25 holdings. So what is this slide showing? It's showing the portfolio value over time for our original portfolio, which invests almost exclusively in dividend growth stocks. As a class project in 2022, we started investing $12.50 each week into the portfolio, and it's now worth over $2,821 after I think it's 164 weeks now. Each week we take that deposit and split it up to buy 10 different dividend-paying stocks. So we're buying fractional shares of stock. Each week we re-rate the stocks, so the list of stocks fluctuates from week to week. And in August of 2023, we started a second portfolio, this time investing in high-yield dividend-paying stocks. Now the tan line on the chart shows what the portfolio value of our dividend growth portfolio would be if we'd instead put the money into a savings account. In our first year, 2022, stocks and bonds did not do well at all. As you can see, our portfolio had overall losses where the blue line falls below the tan savings account line. But the power of compounding is working in our favor as the portfolio really took off starting in November of 2023. Now I'll update our tech stock portfolio in next week's video. Well, I'll try anyway. It's an insanely busy week next week. And that portfolio we started in late April 2024 and has been, as I said before, is our most volatile portfolio because it's only one sector and tech stocks tend to be risky. For those that have been asking, all three of the portfolios are now on my website, which is bethestockmarket.com. We post the stocks we are buying in real time on Mondays when we make our weekly investments, and anytime we sell a stock, as well as information about portfolio holdings and trade confirmation. Now, if you're new to my channel, I'm an accounting professor who teaches accounting, and I often show my students how to use the accounting concepts that I teach to pick stocks, because it gets the attention of my students and keeps them engaged. To show them accounting concepts in action, starting in 2022, we started a class project in which each Monday I invest actual real-world money, $12.50 each week, which is roughly the equivalent of $50 a month, into 10 different dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is going. Also, viewers can use our progress as inspiration for their savings goal and get ideas, company names that you can do your own research on. It's really important that you do your own research. Now, there are timestamp links in the description of the video in case you just want to jump to a list of stocks we bought last week, or the list of our best performers, or any other section of the video. Before we talk about our dividend portfolios in depth, let's look at what happened recently and what's coming up this week. Now, the S&P 500 fell 1.66% this week, mainly because of inflation worries and the fact that Walmart gave a disappointing revenue forecast that made investors question if earnings will be lower than expected for all companies this year. Now, I believe that the main thing that's going to affect the stock market this year is inflation fears and whether that will prevent the Federal Reserve from lowering interest rates. I think it would be kind of healthy if the stock market cooled off this year, as we've had 2 rip-roaring years in a row, and it can't sustain that forever. So I'm kind of hoping that we get more of a mellow year in the stock market this year so we can get some better prices as we reinvest our dividends and as we put more money to work in the stock market. Now, next week, on Wednesday, Nvidia and Salesforce are going to report. They are 2 of the very high-quality momentum stocks that got hammered this past week, and they're also in our tech stock portfolio, and Nvidia is one of our under-the-radar dividend payers in our dividend-growth portfolio. And on Friday, there is a PCE report, which is the Federal Reserve's favorite measure of inflation. PCE stands for Personal Consumption Expenditures, and that's going to be a very important report to hear what happens there. Before we get into which stocks we bought this week, a lot of people have been asking what my favorite books are about investing. My 2 favorite books were the basis for the 3 stock screens I publish on our website, which you can see on this slide. My favorite investment book is called What Works on Wall Street by Jim O'Shaughnessy, whose investment firm managed over $6.4 billion of investments before he retired. The book is the basis for 2 of the 3 stock screens I publish on my website, bethestockmarket.com. They are the Trending Value stock screen and Consumer Staples stock screens. I update the stock screens monthly. So what is a stock screen? It is a set of criteria used to narrow down a large list of stocks to a much smaller list of stocks in which you can invest in or do further analysis of them. The book examines various ways to tell if a stock is undervalued by examining simple metrics like the price to earnings ratio, dividend yield, etc., as well as combinations of those simple metrics. There are a lot of tables and graphs, so if you're a numbers geek like me, you'll probably like the book. It also talks about the history of the stock market and the psychology of investing, which is also fascinating. And just recently I started rereading the What Works on Wall Street book. It's super fascinating. I love it. The other book I recommend, especially for younger investors, was written by the son of the author I just mentioned. It's called Millennial Money and is the basis for the Millennial Money stock screen that we publish monthly on our website. Of course, you can follow the book and just recreate the screen on your own. It's a much shorter book than What Works on Wall Street. I'll try to put links to the 2 books in the description of the video. Also, I recommend checking them out at your local library, see if they have that. Save yourself some money. And because we're investing additional funds each week into most of our model portfolios, the way to calculate portfolio performance becomes more complicated. For those who have been asking, the formula that is most commonly used to calculate portfolio performance is called XIRR, or Extended Internal Rate of Return, and we use it too. It's the same formula used to calculate portfolio performance in Quicken, the most popular personal finance software. You can see the formula at the bottom of the screen. You can calculate it by hand, but if you want to maintain your sanity, you are better off using Excel to calculate it for you and then use Quicken software to double check it, which is what we do. Now in this video we talk a lot about our dividend growth portfolio and our newer high yield portfolio, which is geared more towards those nearing retirement. Now these two portfolios were started at different times. The table at the bottom of this slide shows the portfolio comparison when both portfolios existed. The high yield portfolio was started in August of 2023, and the annualized return so far is 27.19%, which is surprisingly higher than our dividend growth portfolio, which is an annualized return of 17.62% over the same time period. Now, the dividend growth portfolio includes way more growth stocks than the high yield portfolio. I expect that the dividend growth portfolio will have the higher return over the long run, especially since the high yield portfolio has less than 1% of the portfolio in tech stocks, but time will tell. If an investor was solely investing in the high yield portfolio, I would think about supplementing it with some tech stocks for additional diversification. On our website, we have ideas for technology-focused investments that provide income, ranging from dividend growth stocks to closed-end funds and ETFs. Now remember, the high yield portfolio has only existed for 18 months, so its annual return will likely jump up or down to a greater extent than our dividend growth portfolio's return. The fact that the high yield portfolio is outperforming our dividend growth portfolio over the same time period is pretty surprising to me. I keep thinking that the dividend growth portfolio is going to close the gap, but actually lately the high yield portfolio has been extending its lead. Now, a very popular exchange-traded fund that only holds dividend stocks is called the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. No one calls it by the name. They always call it by the ticker symbol. SCHD is a large holding in my personal account, so I've been tracking SCHD's performance closely with our two dividend-paying stock portfolios. As of today, our dividend growth classroom stock portfolio's annual return is 17.52%. Now, if we had instead invested the same exact amounts into SCHD in the same days, the portfolio's return would only be 10.02%, a difference of 74.8%. Our high yield portfolio is also outperforming SCHD, but by an even larger amount. Obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings to about $2,800 a week and reinvesting in our model portfolios. I also prefer our actively managed classroom stock portfolio strategy rather than SCHD's purely algorithmic approach where no one is overseeing the stock selection. SCHD has at times had large positions of stocks that I consider to be value traps, and that's not a good thing at all. Now this slide shows our best performing stocks for our original portfolio, the dividend growth stock portfolio, based on when they were initially purchased. Stocks in yellow have been sold. Our best performing stock so far has been Broadcom with a 293.0% return in less than 3 years. Evercore, an investment bank, is at number 2 with a 252.9% total return. It has been sold. The fastest riser that is still in our portfolio is the Bank of New York Mellon, which has more than doubled in 16 months. And remember that total return includes both the dividends the company has paid as well as the increase in the stock price. Now, as far as the strategy column goes, there's a category called dividend growth stocks. About 90%, technically 89%, of our investments made in this portfolio were made in these stocks. Now, so the dividend growth stock means that they're high quality stocks with a great track record of increasing their dividend payouts to investors. The other 11% of the investments so far have been made in usually smaller, under the radar company like Crane Holdings, F&G Annuities, Repositrack, Finia, WK Kellogg. Now, WK Kellogg's a bigger one, but the other ones are pretty small. Now, so those are usually smaller, and they've recently started paying a dividend. They tend to be riskier than average because they tend to be smaller companies, but studies have shown that they historically beat the market averages by a significant amount. So if you're really good at evaluating companies, you might want to hone in on those. Because they're smaller, there's less competition of people analyzing them, and you might be able to more easily find bargains. So here's the usual disclaimer before we show what stocks we bought this week or last week. This presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own research. So now on to stocks we purchased last week. So as I said, 89% of our dividend growth portfolio is comprised of high quality dividend growth stocks, but the other 11% or so is invested in under the radar dividend payers. Now last Monday we added to 2 under the radar dividend payers that we've already bought previously, and they are Meta and Nvidia. Obviously these are the giant ones. Meta started paying their very first dividends relatively recently and appears to be undervalued and is in the communication sector. Now our dividend growth portfolio is significantly underweight the communication sector when compared to the S&P 500, and I want to boost our allocation to that sector. We also made an additional investment in Nvidia after the stock's price pulled back due to the DeepSeek announcement. Nvidia definitely does not pay a large dividend, nor does it grow its dividend at a high rate. But with its high profit margins and high levels of cash flow, it could definitely become a strong dividend grower in the future. And it's done well for the portfolio so far. Now, if you want to do your own research on companies that have recently initiated a dividend, here's a new slide for you. These companies on the slide have all recently announced they will start to pay a dividend. So in other words, they are dividend initiators. Studies have shown that companies that either start a dividend or raise their current dividends significantly outperform stocks that do not pay a dividend. So many of these are smaller companies and therefore have greater risk and greater upside. It'll be interesting to see which of these companies will become dividend growers in the future. Now, our biggest successes in this category of stocks is F&G Annuities and Repositrac from a previous slide, both of which basically doubled in the 12 months that we held the stocks. Those 2 stocks we held only for 12 months. Usually we hold a little bit longer. Now let's talk about the dividend growth stocks we bought last Monday. I posted these rankings to our website, beatthestockmarket.com, last Monday. And then we purchased the top 10 stocks. And actually, I think Monday was a holiday, so we bought these on Tuesday. Now on this slide are my ratings for the top 15 dividend-paying stocks this past week of the dividend growers. But we only buy 10 each week. So we bought the first 10, so Comcast through American Waterworks. Let's see here. Remember, we use many criteria to filter stocks. And if they are hovering at a required level, they can make the list one week and then drop off the list the next week based on a small movement. Examples of criteria used to filter out stocks include required margin of safety and consensus earnings growth estimates over the next 12 months, which changes frequently. Now for consensus earnings growth estimates, I will only purchase a stock if its earnings are forecast to grow at least 5% over the next 12 months. That's because we want to invest in stocks that can continue to increase their dividends. So a stock might have a 5.2% estimate one week and make the list, but the next week its estimate could dip to 4.9%, which is below our 5% requirement, which means that the stock suddenly doesn't make the list at all. This is just one of many filtering criteria we use to narrow down our list of investable stocks. Now each week we buy 10 stocks, and since we're investing such a small amount each week, it means we're buying fractional shares in our brokerage account. And for those that have asked, we do not automatically reinvest dividends into the same stock from which the dividend was paid. Instead, each week when we are buying the 10 stocks as shown on this slide, we combine the weekly deposit with the dividends that have been paid that previous week and are sitting in the account as cash. We then take that combined total and split it up amongst the 10 stocks we are purchasing that week. Or in this case, we bought 12. We bought these 10 and then those 2 from the previous slide, Nvidia and Meta, which are our under the radar dividend payers. In other words, we reinvest dividends weekly into the 10 stocks we are purchasing that week, or 12 in this case. Now, for the sake of convenience, there's nothing wrong with simply turning on the broker's auto reinvest feature, but we think it's more ideal to reinvest in our top stocks each week instead of potentially investing in a stock that is fairly valued as opposed to undervalued. This table on this slide includes the company's sub-industry, how undervalued they are, according to our research, their risk rating and quality grade and dividend yield. Remember, all these stocks pay a dividend and have recently increased their dividends, and their methodology used here indicates they're likely to continue to raise dividends. Therefore, this is a dividend growth strategy. Now remember, this Dividend-Growth stock portfolio is in a brokerage account separate from my regular brokerage accounts to make tracking this portfolio easier. So in my other brokerage accounts, I'm also investing in these Dividend-Growth stocks and the high-yield stock on the next few slides. This week I purchased over $2,800 of the stocks from those two portfolios as I reinvest dividends and gradually transfer out of my main dividend ETF, which is ticker symbol SHD, and buy these stocks instead. I'm also trying to tweak the buying strategy a bit to see if I can boost returns. I'll share the data with you as once we have enough data. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for about 89% of our purchases. The other 11% so far have been invested in those usually smaller under-the-radar dividend payers that have recently started paying a dividend. Now, these under-the-radar dividend-paying stocks tend to be riskier because they are smaller companies, but studies have shown they historically beat the market averages by a significant amount. So risk is the first quality component, which we mentioned on the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported profits. And finally, the last quality component is financial health. Remember that the risk rating here is comparing these stocks to other stocks, not to other investments like bonds or CDs. Now let's look at the dividend growth grades of the companies. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it usually works. Companies that are already paying out high dividend yields rarely have the greatest potential for the greatest growth in those dividends. This slide shows stocks in our portfolios that have chosen to split their stocks. Since we keep track of every individual purchase in Excel, it's important that we have this slide to remind us to go back and adjust the purchase price, the shares held, and the dividends per share that we receive once the stock split has occurred. And here is a look at the 10 stocks that make up the largest portion of the dividend growth portfolio as of Friday after the market closed. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest into one single company. Aggressive investors might not want to limit the investment into any one stock. But I'm a conservative investor, therefore we temporarily stop investing in a company if they make up more than 4% of our portfolio. This leads to a less risky, more diversified portfolio. So for example, if Visa, MasterCard made our list for next Monday, we would not buy any more of them because they are already at 4% of the portfolio. Now, it's true that our portfolio's returns would likely be higher if we always invested in our top 10 stocks, regardless of the size of the stock's portfolio allocation. But that also creates a more concentrated and more volatile portfolio, and many investors cannot psychologically stick with a volatile portfolio, especially if you're living off the dividends. Volatility often causes investors to panic and sell at the wrong time possible. Now, our portfolio holdings are currently at 105, with 89% of the weighting being allocated to Dividend-Growers. That's a company that has a history of growing their dividend. And the other 11% has been allocated to those under-the-radar dividend payers, which are stocks with a very short history of paying dividends that may eventually become dividend growers in time. Now, that might seem like a large number of companies to keep track of, but the spreadsheet we have developed for tracking the companies makes it obvious when to sell a company once we download company financial and accounting information in the spreadsheet, which we do at least weekly and doesn't take that much time. The thing that did take a long time was creating the spreadsheet. It took 2 long years to create the spreadsheet, to get it finalized anyway. Now let's talk about our high yield dividend paying stock portfolio, which is confounding to me how much better it's doing than a dividend growth portfolio. Now, I've had several older students who are closer to retirement take my classes. They are more interested in stocks with higher dividend yields, and they asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in our dividend growth portfolio. So in August of 2023, we started investing $12.50 each week into stocks with higher dividend payouts. I didn't have super high hopes for this. I didn't have super high hopes for its performance. I knew that the dividend yield was going to be great, but I was kind of shocked how well the portfolio is doing. The portfolio as a whole has an annual return of 27.19%. Since the portfolio has been in existence for 18 months, that return will likely fluctuate a lot more than the return of our dividend growth stock portfolio, which started 20 months earlier. Currently, the high yield portfolio's dividend yield, if you bought all the stocks today, would be 4.15%. Compared to our dividend growth portfolio, the companies in this portfolio likely will not grow their dividends as fast. Therefore, this portfolio would be more geared toward investors closer to retirement. Now, having said that, many stocks in the portfolio have increased their dividends, and we've been able to sell some stocks at a high price and reinvest into better bargains, pushing the portfolio's yield based on the amount we have invested to 5.04%. Now, two strategies are being implemented in this portfolio, as you'll see on the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth. Strategy 2 also features stocks paying higher dividend yields, but places a bit more emphasis on recent dividend growth than Strategy 1 in an attempt to try to get the best of both worlds, that being both a high yield and dividend growth. Now, Strategy 2 has been the better performer so far. The average investment in Strategy 2 has provided a total return of 19.13%, and has been held for an average of 207.8 days so far, which is an annualized return of 36.04% using Excel's rate function. Now, it's not likely that the portfolio can keep up an annual return that high since stocks historically average 9 to 10% per year. However, in the last 2 weeks, it extended its lead over the dividend growth portfolio, and it easily beat the S&P 500. Now let's talk about the high yield dividend paying stocks we bought last Tuesday, I believe, because Monday was a holiday. I posted these rankings to our website, beatthestockmarket.com, and then we purchased the 8 stocks on this list. And because the high yield stock portfolio currently has less than 1% in tech stocks, for those that want to add diversification to this portfolio, I added to my site a list of technology-focused investments that provide income with yields from less than 2%, like Microsoft, to yields as high as 10 to 12%, all of which I either currently invest in or have invested in. I'll also tell you which is my favorite. Of course, the technology-focused investments with the higher yields don't have the chance to grow their distribution yields as fast as one like Microsoft or Broadcom. There's always a trade-off, and don't chase yield. One thing that's different about this strategy, like I mentioned before, versus our dividend growth strategy on the previous slides, is we only purchase 8 stocks in the high yield portfolio, and we have 2 different strategies within this portfolio. Strategy 1 emphasizes a high dividend yield over dividend growth. That's perfect for our investors in retirement or getting close to retirement. Strategy 2, down here in green, emphasizes high dividend yield but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. Because there are 2 different strategies, we have 4 stocks in Strategy 1 and 4 stocks in Strategy 2, giving us 2 rankings. So, as you can see, it's possible that a company could appear in both rankings, like Comcast is in both this week. The 4 high-yield stocks we bought last week while implementing Strategy 1 are Comcast, GlaxoSmithKline, CME Group, and Target. And the 4 high-yield stocks we bought last week while implementing Strategy 2 are Comcast, Huntington Ingalls, PNC Financial, and PepsiCo. Here's a look at last Monday's ratings for competitive advantages, management, and financial health. And on this slide, we can see last Monday's grade for recent dividend growth and current yield, as well as recent dividend growth history. Glaxo pays a variable dividend, hence the less than stellar dividend growth rate. And the last column, you can see their grades for dividend growth potential, which will be much lower than the stocks on average in our dividend growth portfolio, which consists of stocks with usually lower yields, but a greater potential for excellent future growth in those dividend payouts. On this slide, we're looking at our stocks that have raised their dividends recently. The holy grail of investing in dividend-paying stocks is to have the portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a teacher salary. Historically, dividend-paying companies raise their dividends by 5 to 6% per year, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. Once again, we had a lot of dividend increases for our portfolio stocks last couple of weeks. Danaher hiked its quarterly dividend by a whopping 18.5%. This is the 12th consecutive annual dividend increase for this dividend achiever. Now, if you're wondering what a dividend achiever is, I got some definitions here. Dividend achievers have raised their dividends 10 years in a row or more. Dividend contenders have raised their dividends between 10 to 24 years in a row. Dividend champions have raised their dividends for 25 or more years, but do not have to be in the S&P 500. Dividend aristocrats are the same as a dividend champion, but they have to be in the S&P 500. And then dividend kings, which are pretty rare, have raised their dividends 50 years in a row. So after Danaher, we've got Prologis, which hiked its quarterly dividend by 5.2%. This is the 11th consecutive annual dividend increase for this dividend achiever. Thermo Fisher hiked its dividend by 10.3%. This marks 8 straight years of double-digit increases for Thermo Fisher. Analog Devices raised its quarterly dividend by 7.6%. With 22 years of increases, Analog Devices will most likely become a dividend aristocrat within a couple of years. NextEra Energy announced it will raise a quarterly dividend by 10%. This marks the 31st consecutive year of increases by this dividend aristocrat. And Carrot Packaging announced it will raise a quarterly dividend by 12.5%. Now, this follows a dividend hike of 100% last year. Carrot Packaging is one of our under-the-radar dividend payers. Now, Carrot Packaging is currently paying a 5.65% dividend yield. And Gilead Sciences announced a 2.7% increase in the quarterly dividend. It's the 8th consecutive annual dividend increase for this dividend contender. The last 22 dividend increases for the portfolio have an average of 8.5%. This slide shows the cumulative growth of the dividends we receive in our Dividend-Growth stock portfolio. Our dividends for 2024 increased 56% over the dividends we received in 2023, and dividends for the latest quarter increased 43% over the same quarter a year ago. The graph shows how quickly the dividends are growing and is a great example of the power of compound growth, which is what we're after. Albert Einstein is widely rumored to have called compound growth the most powerful force in the universe. So why do we only invest in dividend-paying stocks in our two main stock portfolios? The first reason is, according to a Harvard study, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks, average return has been much lower at 4.27%. Morningstar also recently released a report that went all the way back to 1927 and came up with the same conclusion. Dividend-paying stocks have both a higher return and less volatility than non-dividend-paying stocks. That second point about having less volatility is probably even more important than the fact that dividend-paying stocks have a higher return. So why is a lower amount of volatility so important? Well, it's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So why are dividend-paying stocks less volatile on average? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks, as measured by beta and standard deviation, tend to be much lower for dividend-paying stocks, and that's a good thing. In other words, less volatility. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom stock portfolio of dividend stocks only invests in dividend-paying stocks that have increased their dividend recently. Now, BlackRock recently released a report showing that $10,000 invested in companies that increase their dividends, called Dividend-Growers, and companies that started paying their first ever dividend, called dividend initiators, grew to $2.6 million. That same $10,000 invested into non-dividend paying stocks only grew to $1.2 million. So investments made in stocks that raised their dividends or started paying a dividend grew more than double if the investments were instead made in stocks that did not pay dividends. The difference is 116.7% to be precise. Now, the holy grail of investing is having a stock portfolio that produces two things. One, a growing stream of income that produces enough income to cover your expenses, plus extra cash to cover travel, vacations, luxury purchases, etc. And 2, also produces a growing stream of income that also grows faster than the rate of inflation. And dividend-paying stocks historically increase their dividends significantly higher than the rate of inflation. This means that quality dividend-paying stocks can provide a growing income stream for a lifetime. Now, this is in contrast to bonds, which do not raise their payments to bondholders. So here are 2 examples of stocks growing their dividend payouts over the years. The first is Broadcom, which just increased its dividend for the 2nd time last year and for the 14th consecutive year. Now, I bought Broadcom, which is a chip maker, in 2020, just 5 years ago, for my taxable account. At the time, its yield was 5.01%, meaning for every $100 I had invested in the stock, I would receive $5.01 every year. The company has quickly grown the dividend to the point where the yield based on the original investment is now 9.14%. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen so much. That's why it's important to invest early and be patient. And I fully expect Broadcom to continue to increase its dividends well in the future. And if not, that's why we have constructed a diversified portfolio. That's the power of investing in quality dividend growth companies. My second example of a high-quality company with a history of raising its dividend is Home Depot. In 2003, when I was attending college, I had started a dividend stock portfolio for the investment newsletter that I had started at the time. And Home Depot was recommended for that portfolio and is still in that portfolio today. At the time, its yield was a low 0.83%, meaning for every $100 I invested in the stock, I would receive only 83 cents. Seemingly not much to get excited about. But over the years, Home Depot has grown the dividend to the point where the yield based on the original investment is now 31.1%. And like Broadcom, while there are no guarantees, I fully expect Home Depot to continue to grow its dividend well in the future. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen. Again, that's why it's important to buy early and be patient. Now remember, stocks historically have a higher return than bonds and are also riskier than bonds, but you certainly won't find a bond that pays anywhere close to the yields on the original investment that these 2 stocks are paying. And bonds don't increase their payouts to investors like stocks can and often do. Another reason to own dividend-paying stocks is for the potential to generate up to $126,700 of tax-free income each year if you're married and filing jointly. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you have the ultimate income stream that not only covers your expenses but grows over time. And if you're married and filing jointly, you can make up to $126,700 in qualified dividend income and pay 0 federal tax on those dividends if you have no other income. This is perfect for retirees. If you're single, that amount is $63,350. Those amounts usually increase each year as the standard deduction increases and the tax brackets are adjusted. So how are those amounts calculated? First, you find the 0% tax bracket for long-term capital gains, and then find the standard deduction, which can be located in IRS Publication 505. As you can see, for 2025, the standard deduction increased in November, meaning that you can potentially earn even more tax-free income from qualified dividends than you could in 2024. Then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $126,700 that a married couple filing jointly could generate an income from qualified dividends that would be federally tax-free. So why do we choose to start investing in our model stock portfolio with only $12.50 per week, which is essentially the same as $25 per paycheck? I personally am investing a lot more than that in these dividend strategies, but for our classroom model portfolios, the main reason we started with a low weekly investment amount is because I wanted to show my accounting students that you don't need much to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my current brokerage account allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Originally, I invested $25 per paycheck when I started the dividend growth portfolio, but found the process to be so fun that I split it up and we now invest $12.50 every week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation every year. By the way, I also invest in these same stocks in my retirement portfolio and my taxable brokerage account. Another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assumed the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invested an additional 35 cents each week for a total of $12.09 per week instead of the original $11.74. Now, for our classroom dividend-growth stock portfolio in year two, we boosted the weekly investment 82 cents for a total of $13.32 per week. In year three, inflation wasn't quite as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. And for this year, inflation was even lower than last year. So for this year, we boosted the weekly investment by only 37 cents. So we now invest $14.18 each Monday. Now let's talk about ways to potentially increase the return of our dividend growth portfolio. For those that are okay with giving up some portfolio diversification, I believe there are 4 potential ways to boost a portfolio's returns. Each week, we buy 10 different dividend-paying stocks ranked 1 through 10. On average, the stocks in positions 1 through 5 outperform the stocks in positions 6 through 10. Therefore, the first way to potentially boost portfolio returns is to buy only the stocks in positions 1 through 5, or 1 through 6, or 1 through 7, or 1 through 4, whatever you want to do. However, the downside is this reduces portfolio diversification, but some investors are comfortable with a more concentrated portfolio. So far, investing in only stocks ranked 1 through 5 would have improved annual returns 90%. But I personally prefer a more diversified portfolio since the goal of my dividend portfolio is to live off the dividends. So number 2, don't limit individual holdings to 4% of the portfolio's value. So normally, if a stock's allocation of the portfolio is 4% or greater, like MasterCard and Visa currently, I won't purchase more of that stock. This technique reduces the portfolio's risk by ensuring the portfolio doesn't become heavily weighted in 1 or 2 stocks. I purposely created this portfolio so it would be very diversified because the ultimate goal of dividend investing is to have your dividends cover all of your expenses, plus generate extra income for vacations, travel, etc. I'm a conservative investor and I'm personally investing a lot in these dividend portfolios. So I want to make sure the portfolio is not only well diversified between sectors, but also between industries and even sub-industries. That way, when the inevitable dividend cut happens, it doesn't affect one's cash flow in a major way. However, an investor who has a higher risk tolerance and therefore doesn't mind a more concentrated portfolio might try removing the 4% limit in an attempt to boost the portfolio's returns, especially if the company is in the top 5 of that week's rankings, as mentioned in bullet point 1. So far, not limiting individual stock positions to 4% of the portfolio would have improved annual returns by 53%. But again, I personally prefer a more diversified portfolio. Number 3, you could skip the under-the-radar dividend payers. So the under-the-radar dividend payers, despite having some incredible performers like F&G Annuities 119% gain in 12 months, and Repositrax 97% gain in the same time frame, on average, the under-the-radar dividend growers haven't performed quite as well as the dividend growers in the portfolio. So skipping the under-the-radar dividend payers is an option to boost the portfolio's return. One possible reason these stocks haven't done quite as well as the dividend growers is because many of the under-the-radar stocks are very small companies, and small companies have not performed as well as large companies in recent years. Like the previous strategies, this method reduces portfolio diversification. And number 4, you could sell when a stock is fairly valued, even if dividend and quality metrics are excellent. Now, we don't sell often in the portfolio and tend to only sell if the company cuts a dividend or the stock appears to be overvalued or the company's dividend and quality metrics falls out of the top 50% of companies. In other words, if a stock appears to be fairly valued but the dividend and quality metrics are still good, we usually will not sell a stock just because it's fairly valued. But if you have your own valuation methodology and it signals that the stock is fairly valued or even overvalued, you might try selling at that time and reinvesting that week's top 10 stocks that we are buying. The downside would be higher turnover, but this could boost your portfolio's returns by not holding on to fairly valued stocks. If you try this, I'd be very interested to hear your results. Of course, this fourth strategy is the most difficult to implement of these four methods because you have to implement your own valuation methodology. But some people do something really simple for valuation, such as the PE ratio. And for those looking for a less hands-on approach, let's talk about some options to potentially simplifying things. For our model portfolios, we invest weekly, but there is no hard and set rule that says to do that. Most people invest with every paycheck, meaning that most people have funds taken out of their paycheck, which is usually paid every other week, and it's automatically invested in their 401k. Now, when I started our Dividend-Growth stock portfolio, I originally invested $25 every other week instead of $12.50 every week. I only switched from every other week to weekly because I found the process to be fun. The advantage of investing every week as opposed to every other week or monthly is you get more diversification. So if one does not mind less diversification in their portfolio, option one is to invest every other week or monthly instead of weekly. Option two is to just buy the high quality stocks, meaning those with a quality rating of B- or better, and hold forever. Over time, some will turn out to be clunkers, but they will just become very small parts of your portfolio as you let your winners run. That's it for this week. In the comments, let me know if you have any questions, and also let me know what portfolios or investment strategy you would like to see more of. And finally, here are the places you can reach me. YouTube, obviously, as well as our website, beatthestockmarket.com, LinkedIn, and Twitter. We'll see you again next week. Bye.